Welcome, everyone. Welcome to another episode of Wealth Talk. First and foremost, apologies for missing last week's session. As an RIA, Registered Investment Advisory, compliance is our top priority. Sometimes regulators come and check whether compliance is smooth and if we're following all the rules, which recently required all key team members, including Prasad Garu and myself, to be present. That's why we had to skip last week, but going forward, we plan to record the video earlier to avoid such disruptions. Today, let's discuss ways to boost consumption. The GST Council has simplified rates to just 5%, 18%, and for sin and luxury goods, it is 40%, the highest. The biggest change impacts FMCG, especially for daily essentials, where GST has dropped from 18% to around 5%. Many consumer fast-moving goods previously taxed at 12% are also now at 5% or even 0% in some cases, a major relief for items in the lower price range. First, let's hear from Prasad Garu on the government's push to increase consumption. After that, we'll review specific sectors, starting with FMCG, and discuss fundamentally strong FMCG stocks to consider.
This August 15th, the Prime Minister said from the Red Fort that regardless of foreign pressure, he would protect our farmers, dairy, and small industries. This assurance was well received because many Indians live hand to mouth and could be devastated if foreign goods flood these sectors. The government, despite American pressure and high tariffs, held firm. America's actions are impacting India's exports by less than 0.2% so far, though there's a risk of unemployment in sectors like textiles, auto, and mobiles if exports decline. To address this, officials are working to redirect affected exports to other markets, taking a proactive approach this time. If export demand collapses, domestic consumption must absorb the excess, ideally with only a slight price cut. However, India's buying capacity is lower than export prices, so the government has focused on raising domestic purchasing power. GST reforms, reducing and simplifying rates, aim to boost spending power by lowering costs. Now, over 90% of goods are grouped into just two slabs. Government insists these rate reductions benefit consumers, not just traders, since competition forces sellers to pass on lower prices. As a result, nearly all citizens benefit, with the lower and lower middle class gaining most, since a higher share of their income goes toward essential spending. Industries across the board are affected by these changes. To evaluate impacts, let's look at FMCG stocks as of August 14th and their growth by September 4th. The FMCG sector rose 7% overall, while the general index went up only 0.42%. Companies like Zydus Wellness, Britannia, Colgate-Palmolive, Dabur, and Hindustan Unilever grew notably, with many exceeding 10% gains. However, not all stocks are immediate buys. Investment discipline is important. Select fundamentally strong companies only if there's at least a 30% discount to fair value. Of 17 screened stocks, 13 look good, but only Procter & Gamble Hygiene offers up to 38% upside and stands out as attractive for new entry. Others, like Varun Beverages, 28%, Colgate, 23%, Dabur, 23%, ITC, 21%, and Britannia, 20%, are suitable as academic references or to hold if they're already in one's portfolio. Caution is advised when considering new purchases in this sector.
FMCG was well covered, including packaged and pre-packaged goods. The GST Council also made headlines by making paneer, milk, and some other dairy products tax-free, providing a significant boost. Should these dairy stocks be considered separately, or are they part of FMCG and analyzed in the same way?
India has consistently resisted foreign pressure to open its dairy market, protecting the livelihoods of millions of families who depend on raising cows and buffaloes. This stance continued despite efforts from New Zealand, Australia, and more recently, the United States. As a result, along with recent GST rate reductions, there has been a positive response in the food sector, especially dairy. Looking at major listed dairy companies, each with over 2,000 crore market cap, the sector grew 6.72%, over 16 times the 0.42% index performance. Parag Milk Foods rose 14%, Dodla Dairy 11%, Hatsun Agro 5%, 3.4%, Heritage Foods 3.8%, Jubilant Foods 3.54%, Vadalal Industries 2.32%. This reflects higher demand for protein-rich foods as purchasing power increases. However, despite this growth, none of these dairy companies currently offer sufficient value for new investment, not even a 15% discount to fair value, let alone 30%. So, while volumes and profits may keep rising, there are no attractive buying opportunities now. Let's move to the next sector.
FMCG food products, including daily prepackaged goods and dairy, mainly benefit the lower and middle classes by boosting consumption. Now, moving one level up to appliances like ACs and TVs, the government has also made a significant change. GST on products such as air conditioners and TVs, previously taxed at 28% without input credit for consumers, has now been reduced to 18%, resulting in substantial cost savings. This reduction gives a major push to domestic appliances, electronics, and consumer goods like washing machines and TVs. How has this sector performed? And among companies in appliances and electronics, are there any with strong fundamentals worth considering?
This industry is seeing strong support. Previously, high tax rates made buying appliances like ACs, washing machines, and TVs difficult for many with hand-to-mouth expenses. Now, with GST reduced, demand has surged, 100% volume jump, as first-time buyers and repeat buyers upgrade their appliances. Companies have also expanded production capacity, poised to grow margins and profits. Among 7 large companies, market cap above 2,000 crore, the sector grew 6.84%, far outperforming the 0.42% index. Notable performers include IFFCO Industries, 18%, Whirlpool India, 8.76%, Eureka Forbes, 8%, Titagare Prestige, 6.93%, and Orient Electric, 4.5%. Looking at growth potential, Whirlpool, 37%, and Orient Electric, 34%, stand out as attractive buys. Symphony, 25%, is a secondary option. Bajaj Electricals, Titagare Prestige, and IFCO Industries lack sufficient growth gaps to buy now. So primarily, only Whirlpool and Orient Electric are recommended for purchase, with Symphony as an additional option.
Right. Next come automobiles and allied ancillaries, both major industries, specifically the GST cut from 28% to 18% covering cars and motorcycles below 350cc gives a clear boost. Earlier, we saw benefits in food and appliances. Now, commuting quality can improve too. For someone shifting from bike or scooter to a car, this means 5 to 10% savings. Consumption and sales should rise for players like Mahindra and Tata Motors, adding to their profits. The key question is, are there any speed breakers ahead, or is this purely a positive government move?
This is definitely a good news. If people's priorities are clear, first a house, then children's education and health, and next mobility. Everyone, whether salaried or a businessman, needs transport. As incomes rise, the natural upgrade is from bicycle to motorcycle, then from small car to bigger car. So, in automobiles, demand is always open. Compared to other industries, this sector has surged. While the index rose 0.42%, auto companies together shot up 9.67%, which is 25 times the index, between August 15th and September 4th. Ola Electric led the way due to its gigafactory plan and efforts to build batteries without rare earth minerals. TVS Motors and Hero Motors rose 13% each. Maruti Suzuki and Eicher Motors gained on strong 350cc models. Bajaj Auto and Maharashtra Scooters function almost like finance companies now. Escorts Kubota grew 6.85%. M&M had already risen earlier but still gained further. With such growth, the question is, what's next? Looking ahead, these companies stand out. Force Motors with 37% growth potential, SML Suzuki with 33%, Escorts Kubota Tractors at 29%, VST Tillers at 27%, and Bajaj Auto at 21.73%. Production may not expand instantly, but existing capacity in plants gives scope. So, like domestic goods and appliances, select auto companies look favorable for investors now.
Next comes maybe the biggest update after automobiles and FMCG, insurance. GST on life and health insurance has not just been cut, but fully removed, a massive boost. For countries moving from developing to developed, insurance and healthcare, primary and secondary care always improve alongside. With this relief, more people will take insurance, leading to greater hospital use. Those earlier hesitant due to treatment costs may now actively seek care, giving higher priority to health. This means hospitals are poised to benefit. For this week, focus is on hospitals. Prasad Garu, how do you see them positioned? If insurance rises, will the premiums reaching hospitals really make a difference?
What you said makes full sense. In India, about 130 crore people lack health insurance, not life but health. Without it, sickness often pushes families into unbearable situations. The government found that those just above poverty, lower middle and middle income groups focus first on house, food, clothing, and education, leaving little for health insurance. Now, with some expense relief, attention may shift toward it. Insurance companies believe this and will be aggressive, creating opportunities. If 1,000 people buy policies, maybe only 100 fall sick, but everyone gains security, patients get quality care, hospitals benefit, and society as a whole gains. Clearly, this is a strong move.
Looking at market performance, while autos and appliances have grown, hospitals haven't much. Combined growth is only about 1%, so opportunities exist. Among them, Rainbow Children's Hospital, Hyderabad, shows 43% growth chance, Kovai Medical Center 38%, Narayana Heart 37%, and KIMS 30%. These four look most attractive. Beyond that, Global Health, Metropolis Medical Facilities, Dr. Lal Path Labs 22%, and Aster DM Healthcare 15.76% also show potential. 7 companies in total with over 15% gap to be filled. In our view, the 4 highlighted names are best suited right now. We'll stop here today, but many more industries remain to be covered.
With that, we conclude this week. It was a bit lengthy, but we cleared backlog and focused on GST, covering only key sectors. In the coming days, we'll take up pending industries with updates. Given the geopolitical scenario, if any major economic or investing news arises, we'll discuss that too. Let's meet again next week. See you. Bye.